Like Tesla actually followed like a perfect pattern, to be honest. Like this shit, I was predicting support right here, around 702 to 786. Or actually, this right here is where I would have bought, but I'm surprised it went all the way down to 786 retracement 346, and then held that perfectly. This is what surprised me. Like I was fucking telling my brother to wait and buy right here, and then he bought, but then he sold too early. He sold way too early, and look at all the fucking movement he missed, bro. He missed all that shit. He missed all that, dude. Yeah, pass on Tesla. Dude, look, that was just fucking that short squeeze, bro. I don't know. Tesla is capped though. It's got the bearish divergence. So Tesla's capped. I don't think Tesla will go up in here. I think most of these were a short squeeze. So after all the bears got squeezed out. Also, this leg, this is a ABC. Not ABC, this is a 1, 2, 3, 4, 5. There's an Elliott wave right here. This is the 1, 2. This is wave 3, wave 4, wave 5. So now you have to get an ABC pullback. So you gotta see something like this. A, B. Wait, C can't be lower than 4. So it's gotta be like somewhere here. Like 1.4K. I don't know. But I don't know. Elliott waves don't really follow a general rule anymore because of how the markets evolve. So ignore that shit. Just use Fibonacci. Fibonacci always works, bro. Like I'm pretty sure this is like 1.68 extension. Let's see, dude. I'm curious. Cause like Tesla follows a Fibonacci pattern really well. I'll talk about Tesla by this guy. Now Tesla actually follows a really predictable pattern. Like I'm pretty sure right here, just like eyeballing it, this is probably like 1.68 extension. This is probably a 1.68 extension off that pullback right there. Like I could just fucking tell by eyeballing. What is this? 1.68 right here. Holy shit! That's more than 1.68. Yeah, because it pulled back to 786. So you would expect a much bigger movement. So 1.68 minimum is where you would sell and take profits. And then it came back down here after I broke the 1.68 resistance. And then made that into support. So I guess the larger the pullback, the more you would expect for the next wave, for wave 3, because wave 3 is the biggest wave too. So that's literally wave 3 of Elliott wave. This is wave 1, 2, 3, 4, 5. That's literally wave 3. Wave 3 is always the biggest wave. I wonder if this can be projected from here. Let's do trend-based extension. Even 1.68 is pretty close to that high. Closed above the 1.68. So trend-based extension was probably better. But I think it's time for a pullback now though. I forgot what? The ABC cannot be lower. Cannot be lower than what? 1, 2, 3, 4, 5. ABC. It can't be lower than wave 4? No, it can be lower than wave 4. It just can't be lower than wave 1? I don't know. Elliott wave is a meme. This shit's a meme. Yeah, it can be lower than wave 4. Just not lower than wave 1. So I'm guessing we pull back to something like this. With the A. Actually, you can't even tell. You can't even predict where wave A will win. I'm guessing maybe like that. A cannot be lower than 4, so it has to be higher than 4. So I'll assume we pull back there. Actually, let's use fib. You can't go wrong with fib. So assuming that's the high, this has to pull back say 786. And then we take this measured move with this ruler, fancy ruler, of this high. Mark it to low. That's a 630 point move. So we take this. Actually, how high could it bounce though? That's the thing. That's what matters. So let's say, I don't know, my other chart that I had on this was actually spot on. So let's say this bounces up to 618 because Tesla is very bullish. Then we take this measure move from here and then project it. Boom. Project that shit. Wait a minute. Project that shit for wave B. So wave C should end around here. Slightly below wave 4. This is wave 1, wave 2, wave 3, wave 4, wave 5. And then you get the ABC pullback. And then C cannot be lower than wave 1. So that's about correct. So support should be around here. 1.3k is where Tesla should find support. I'm just surprised Tesla is actually following a really easy predictable pattern right here. So 1.3k is my prediction for Tesla. Because we have the daily bearish divergence right here. So this signals a top for wave 5 because we formed that divergence, and this divergence is already peaking right here. It's already peaked. You can even tell in the weekly it's peaking. So yeah, we have a bearish divergence on the daily and weekly. So yeah, 1.3k Tesla is where we should find support. That's just based off TA though. I know you're not here, Fee. Oh. I know you're not here, but you can always look back on the stream. That's just my prediction though. I'm curious what you would predict for Tesla, because you trade off fundamentals. So I'm curious what the fundamental side would say about Tesla. Because this measure move right here for when to buy Tesla was actually perfect when I did this spot on prediction in this green box. Like, it did go slightly below, but I think that's mostly because a lot of people short sold and panic. Because you always gotta expect the over, what do you call it? You always gotta expect the over, what you might call it, I don't know, where it goes below support, because a lot of people panic thinking support's gonna break, it's gonna crash. So you gotta expect the panic. So that's why I broke below this support. This was actually 786 support as well. It's also the 200 moving average on the daily, I think. As blue. Yeah, blue is 200 moving average. So we have the 200 moving average daily, 786 support. This was actually very predictable then. And then I did tell my brother to buy around here, around $400. He did buy, but he fucking sold way too early at like $500 or $470. Because he was afraid. Because like he bought at $400 or like around $450. I told him to buy around $450, $400 to $450. I honestly didn't think 400 would break, but I mean, there is the 200 daily moving average, and it bounced off the 200 daily moving average, which is the blue line right here. The 200 daily moving average is the blue line, and then it also bounced off the 786 support, which we actually didn't even touch, but that's also like a time to buy for an oversell. That's a time to buy. But you shouldn't be expecting this to break the highs though. You should only expect this to break. You should only expect this to retrace up to the 618 or 786 fib. So if you were to buy here, if you were a day trader, if you were to buy here on that 76 support that we had earlier, you would sell into this golden area right here. So 730 up to 760 or 800 if you're fucking ballsy. If Because like, look, this even shows in the pattern too. Like once we hit the 786, we pulled back down, right? So this would have been perfect if you sold $817, which is where you would expect resistance. And we saw the resistance because as soon as we hit this number, we fell down, and then we consolidated for like 2 weeks, 3 weeks. So there's clearly a resistance right here. It's just that the moment that we broke this resistance, that gave us the signal, this resistance right here, this high. The moment we broke this high, moment we broke this high, on the daily and saw that it was still going after this pullback, right? Look, if you look at it very closely, let's go into the 4-hour chart. We saw that it broke this high and then it retraced down to retest this high as support, and then it held. So that's when you would know to buy, is after this test of this support line. So that's when you would re-enter after selling over here. Anyways, I'll let you look into my stream, my VOD later, Fee, because I know you're not here. That's just, oh, you're back. Oh shit. Alright, I'll let you look into my VOD for everything I just explained from a day trader's perspective, because I'm curious how you would look at it. That's just because you're you trade off fundamentals. I'm curious how you would look at it, but that is how a day trader would look at it. I don't know, do you even use TA at all, Fee? I don't think you do, huh? You just use fundamentals, right? But I mean, I had this mapped out all for my brother. It's just he didn't follow the plan because he panic sold, took profits too early. But I'm surprised it actually followed the pattern like exactly as I predicted. So right now, I think support will be 1.3k for Tesla. What would you say? Just based off fundamentals, I'm curious. But I guess do you not really use it for a quick glance? Yeah, okay, I see. Yeah, TA is like it gets really advanced, but TA evolves because the market the market structure and price action evolves. So TA from 10 years ago is not going to be the same TA in 2020. Like TA in 2010 is not going to be the same as 2020. You have to learn how the price action evolves and adapt to it. From the cash flow model, etc. Okay, yeah. That makes sense then. So like this is what I had mapped out for my brother, right? I did I'll go over it again, so you don't have to look back on my stream. But based on a day trader's perspective, looking at the weekly, I told him to buy around like the 786 retracement, right? Which is around 350, which is around the 350 area. But I told him a good area to buy would be the golden area, right? Which is 413 up to 450. So he bought around like 450 and 400 because he averaged down, right? Averaged down to 400 and 450. So his average price was like 425. But he sold way too early because he got scared. But I told him to buy around here, and this actually held perfectly. It held perfectly on the Fibonacci 786. And also on the 200 daily moving average on the day. This is also, wait. This is that's the 50 day? The green line is 50 day. Yeah. It held on the 50 day or 50 weekly average, the green line. And on the daily, it also held on the 200 day moving average. So these were confluent with each other, and they were confluent with the 786. So you have 3 layers of confluence: the 786 Fibonacci, the 200 day moving average, the 50 weekly moving average, and like what else? Let's see. Yeah, so you have three layers of confluence. This had to hold right here. It was really obvious. But everyone uses it, not just you. Everyone has the same data. Yeah. Everyone uses the same technical analysis as you. That's why basic technical analysis will not work. You have to use technical analysis that has been evolved. So like, technical analysis will always change is the thing. So everyone, I'm not saying you are. No, you're right. You're right 100%. V. Technical analysis, everyone uses it, but what they're using is not Like everyone uses technical analysis to see what other traders are thinking, right? That's part one of technical analysis. Part two is how to outsmart the other people that are seeing the same thing, you know? That's why there's such things as stop hunts and stop runs. That's why I say, like, you see this technical analysis, right? And I'm seeing that this is gonna hold at $400, right? Because people like whole numbers, right? $400 is a good number for support, right? So what would somebody who is a market maker or a whale in the market, like say a hedge fund, what would they do if they know that people are going to buy $400, right? They're gonna run their stops, right? If someone buys $400 on Tesla at 400 because they see this Fibonacci 786 is $346, 618 is 480, they want to buy somewhere in this golden ratio zone, right? This like $400 to 450. They're gonna expect $400 to hold, but no. If someone is smart, this is part two of technical analysis. Part one is like everybody is using the same TA is part one. Part two is how to outsmart the retail traders that are using the same TA as you, because everyone is gonna see the same thing. So if you want to be a successful trader, you have to outsmart everyone that is using part one. And that's where the fun part comes in, and that's how you beat other retail traders. So these retail traders are going to expect $400 to hold, right? So if I'm a hedge fund manager or like someone owner of like a really large capital and I trade a lot of money and I see this 200 daily moving average and this weekly moving average, and these are all on the same price, right? The 50-day moving average is this green line right here. $350 on the weekly. That's a 50-day weekly. 200-day moving average is what? 370? Yeah, 370. So I'm gonna expect somewhere around here to hold, right? But people are going to want to get in and front run each other. So there's gonna be the majority of the market seeing this moving average and they're gonna expect it to hold. So they're gonna buy at $400. They're not gonna wait for this moving average because they know everyone is looking at the same price to buy. So they're gonna front run each other. But if I am a hedge fund manager, what I'm going to do is I know that people are gonna buy and try to hold 400. So if you want to look at the smaller time frame, I bet you what they did was they did like a huge market short or market sell to push this price lower below $400. Because where's $400? Let's look at the lower time frame. You will see they actually ran the stops over here, right? This is the hourly, right? So here, look. So at this ticker right here, $400. You see, let's look at what the low is. Low is $396. So that's like almost $400 exactly, right? They see this, everyone buys, it spikes up $400 up to $470, right? Because everyone's thinking, oh, $400 is gonna hold, right? But no, if I am a hedge fund manager and I know part one, which is what everyone is thinking, because everyone's using the same TA and seeing the same shit, right? So if you're the hedge fund manager, what you want to do is you want to run their stops, right? So you see this big ass wick, right? You see this hourly wick? So you see this big hourly wick. Let's even go, I wonder if I could go 15 minute. So this is how you outsmart other traders. Actually, can I see 15 minute? Is there enough data for this? Yes, there is. So this is how you outsmart other traders, right? This is how you be a successful trader and not some newbie that only uses TA and expects it to work 100% of the time. Because that's only part one. Part two is outsmarting the other traders. So everyone expects this $400 to hold. So you see this huge spike right here, right? But I am the hedge fund manager. I am the whale. So I see this huge spike. So what I'm going to do is I'm going to put a market short right here on the previous high, right? You see this previous high on the 15 minute? I'm put a market short right here on this line perfectly. Or a limit short. And then once my limit shorts are filled, not market short, I meant limit short. Once my limit shorts are filled, I'm just going to keep a huge limit order right here to prevent it from breaking this high, right? That's what I would do. If I had a lot of money and it didn't matter how much capital I had, because I'm always hedging, right? Because I'm a hedge fund manager. I'm always hedging on something else in case my trade goes wrong. But at the same time, a hedge fund manager would manipulate the market, which is against like SEC rules, but they can't really prove it. They can't really prove your intention to short Tesla and say that you're manipulating the market. But I mean, everyone does it. And you know that shit fucking happens. So you put this huge ass fucking order block right here, right? On this previous high. Because everyone's buying 400 and they expect a huge spike. So you're shorting into that, and you're putting such a huge sell wall right here that it cannot break. And then once all the fuel for the buyers run out, then it's gonna go down because you have such a huge wall right here. People already see the resistance, so they're gonna sell their shit again. And you're gonna see the people who bought $400 thinking, oh, okay, what's gonna happen is that it's just gonna keep going up. I should just hold on to it because I'm already in profits. When you're in green, you should stay in green, right? That's what basic TA tells you. That's what every fucking newbie trader, beginner trader tells you. When you're in green, just hold on to it so then you can keep it long term, right? But no. Part 2, the smart trader, hedge fund manager, someone who's experienced, will know what you're thinking because it's fucking newbie strats. 90% people who lose money on trading because they're noobs. So they see this, they put this huge sell wall, they have all these shorts, right? So since they have so much money, they can just keep on putting a sell limit right here and prevent it from going up. And eventually the price has to drop, right? And when it starts dropping, the hedge fund manager knows that the stop is right here, 400. So when it starts dropping, what they can do right here is put another market right here, run those stops, because they know everyone's going to put stops right here. 396 previous low. If you bought $400, where are you going to put your stops? 396, right? So plan 1, you know everyone puts their stop 396. And then plan 2, you know everyone, you're going to expect this bounce because 400 is a whole number. That's going to be a support, right? So hedge fund manager, you know it's going to bounce 400. You're going to put a short at the previous high on the 15-minute. And this is happening really fast because it's 15-minute chart. And this is how a day trader looks at it. So you see, you're the hedge fund manager. You're going to put the short right here. You got to think like this if you want to be successful with day trading. You cannot just trade off basic TA. You have to outsmart the newbie traders that use this basic TA and know how they think. So it's more about psychology. You got to look at the psychology of the market and the market structure. So yeah, you have all these shorts filled, right? Your goal is to run this $400 stop. There's $396 stop. It's the previous low. And you see that what happens once you run it? Once you ran these low, you see all these people who are just in green. Remember what I said earlier? People who bought at $400 have the mindset of thinking, when you're in green, you should hold it, right? You want to let your shit grow, right? That's the fucking dumbest shit ever. The reason why fucking like Wall Street tells you to hold on to your green stock is so like everything Wall Street tells you to do, you should do the opposite of, because they're teaching you how to be a bad trader, right? The only way for Wall Street to make money is if you're a bad trader. So what's going to happen is you watch a lot of CNBC, so you're going to listen to CNBC because you're a fucking newbie. You just started trading a year ago. You've been losing your money constantly. But the hedge fund manager, who told CNBC to tell you to do this, is going to run your stops, dude. He knows where your fucking stops are, right? And he's going to keep on running it until, all the stops are hit right here. I wonder what the volume is. I want to see what the volume. VP? No, I can't see. I can't use VP for VR. Where is my... Do I not have the volume indicator? I actually don't think I could see 15-minute volume. Oh yeah, there's the volume. Look at that, dude. Look at this. So if I have fucking my stops right here. Look at this, dude. The same volume that caused the spike right here is the same volume over here. Do you see the pattern? The people who bought right here are the same people who had their stops ran right here. Because you see the volume, they're identical. This is the same fucking volume for the people who bought right here. These people are selling at a loss, even though they were green earlier, but they got greedy, right? They listened to CNBC to hold onto their shit. So these people are newbie traders. These are the part 1 traders. You want to be the part 2 trader. You want to be the hedge fund trader. You want to know what the hedge fund is thinking. This is how hedge funds take your fucking money and fucking shit on all the 90% noob traders. So if you want to be a successful day trader, this is how you have to think. You can't be trading purely off TA. You have to think about how retail traders or noob traders are thinking. You got to know their mindset. So you see this volume right here? It's the exact same volume right here, right? Look at this. This volume right here, same right here. Everyone that just bought right here sold for a loss. And who is making money off of that, right? You are the hedge fund manager. You shorted right here. at this previous high because you know how these newbie traders think. You set a huge limit order right here, limit sell, to prevent it going higher, so that you can run these stops. That was your objective. Your objective was to prevent it from going up and then running these stops. So you did that successfully by setting a short right here. Right, you did that successfully. You can tell they did this successfully by looking at the volume. It is the same volume right here as the same volume right here. These are the same amount of volume. Everyone that bought right here at $400 sold for a loss below $400 all the way down to $350. So this is how Wall Street takes your fucking money if you're trading on Robinhood, right? Because everyone on Robinhood is a retail trader. I don't fucking use Robinhood. I don't think anybody should use Robinhood because Robinhood likes to jack up the prices. And actually, I don't know. I don't really use Robinhood, but back then they used to jack up the prices. So you should be using like TD Ameritrade, looking at the order books, right? Then after Tesla stock, you may see Tesla stock price, right? Same discussion. Does like stock split is usually good though, right? Isn't it? Because stock split allows more people to enter the market, because in stocks you have to buy a single share. So shouldn't you see a surge after that and then a correction back to the normal price level? So like if this split 1 for 2, this would be like 1K, right? So you would see a surge up to like maybe like 1.2K, 1.3K, and then it will correct down to 1K again, right? Oh, well, this high? Yeah. Well, this high is bearish. I'll explain after I explain how hedge funds manipulate these 90% retail traders and why 90% retail traders lose money. So we already explained how everyone here lost money that bought at $400 because they were greedy, and I already explained how Wall Street manipulates the market, right? So Wall Street has made everyone that bought $400 sell, because you can tell it's the same volume right here on the volume as over here. It's obvious. So once we ran all the stops, we also see that this is the support. You cannot break this 350 support, because remember I said this was the 200 daily moving average and also the 50 weekly moving average. So even though retail traders see this, they're already panicking because what? $50 down for $400? What percentage is that? They're down what? 12? What is that? 12.5%? Is it? That's a lot of fucking money, dude. If you bought $400 on Tesla right here, and it goes down to $350, dude, that's 12.5% loss, bro. That's a lot of fucking money, right? These guys are gonna panic. So yeah, you've successfully ran this $400 stop by manipulating the market by setting a limit order here to prevent it from going up. And you know where the stops are. So you hunted their stops. You're the hedge fund manager. You hunted their stops. You know everyone that bought there lost money because it's the same volume. Now, what are you going to do is that you will see that other hedge funds, right? You're not the only hedge fund manager trading, right? You're not the only large capital firm trading Tesla, right? So large capital firm, you're a hedge fund manager, but like 10 other large caps or large capital investments and firms are trading it. They all see the same support: 200 daily moving average, 50 weekly moving average, 50 weekly moving average, and 786 Fibonacci. This is where everybody would buy. Everybody would buy this right here, even if you're a hedge fund manager. There's no way to manipulate the market any further, right? You cannot manipulate the market any further, because you've already manipulated it at $400. This was predictable, where people were gonna buy at $400, right? Because look at this. $400 is a whole number. Day traders like whole numbers. They expect whole numbers to be support, but you are the smart hedge fund manager, part 2 trader. Everyone that was like part 1 trader that only trades off TA, the dumb people, this went up like $400 to $470. What is that? 70 over 350. That's already 20%. They were up 20%, right? If you're up 20%, you're gonna hold, right? Because you're dumb. You listen to CNBC, you're up 20%. So you're up 20% right here. You're gonna try to hold that shit, right? Because you're fucking dumb. But no, your 20% gain becomes a fucking 12% loss. You're gonna panic sell, bro. So all these guys already liquidated. But here, there's no more ways you can manipulate the market, which is the perfect time to buy, because there is 3 layers of confluence right here. 786 Fibonacci, which is huge. And there's the 50-day or 50 weekly moving average, which is also fucking huge. 200-day moving average, which is even bigger. And I wonder if there's even a fucking bullish divergence. If there's a bullish divergence. Actually, you can't see it on the 4 hour. Let's see, 1 hour. I wonder. I don't think there is. No, there. Oh, wait. Here we have a low right here, and then another low right here. No, there's no bullish divergence. So yeah, there's 3 layers of confluence right here. There's no way to manipulate the market any further. So this is the perfect time to buy. And here is how you would sell your buy right here. This is how you would exit. You already have your entry planned, right? Because you're the hedge fund manager. You know how to manipulate it. And you have to think like a hedge fund manager manipulating the stock market, which they actually do, but the SEC cannot prove it because they just can't fucking prove the manipulation, because this is 100% legit, right? Even though they're manipulating the price, think about all the shorts that they shorted right here at 470. Once you hit that 50 moving average, do you see this huge spike fee? Look at that huge spike. Look at how... Yo, yeah, Toink, thank you for the fucking follow. I'm sorry, I'm not playing Kovacs right now. I'm teaching my friend Fee how a day trader thinks, because he's a finance. He trades finance. So he's like a long-term trader. He's like he would be someone that works for a hedge fund. So I'm explaining how a day trader would think, a successful day trader. So yeah, look at this huge spike fee. This is on a 15-minute chart. Within this 30 minutes, you know, the hedge fund guy that shorted right here with a huge limit sell order has to cover right here, right? Look at this huge fucking candle. Look at this. How big is this candle? How big is this fucking Hulk dick? Right there. That's 86 points from 350 in 30 minutes. That is where he covered, bro. Like it's so obvious. Like once, you know, yeah. Like I know you're new to this, and you probably have no interest because you like to relax. Like trading long term, using fundamentals is the safest route for the way you trade. Day trading is more risky. That's why you should not risk more than 15% of your capital. But 15% is even a lot. For me, I was fucking leveraging 5x, which is why, even though I have like advanced knowledge of trading, it's just super boring for me. It's just super boring. Like if I start trading stocks and only risk 15% of my capital or 25% max, no more than 50%, because like you never want to go more than 25%. But if you have to, you can always double down, right? You get to double down twice. You get to fuck up more times with the less capital you have, or with the less capital you trade, right? Because you can always double down your position. You can always average down. And no, you can only average down until you run out of money, right? So that's why you shouldn't risk more than 15%, but 25% max. Ideally, 15%. But yeah, this is how me, someone who would be successful at day trading, because like that was how I made my 200 grand, would be thinking. Also, that's also before I lost it, because you can't make money. We already talked about this, but I lost it by leveraging and also by trading against AI, against bots. But this is about retail traders versus hedge funds, right? But remember when I said that this hedge fund was shorting right here at 470 on this previous higher here fee? Look at where he covered. You know he covered here at 350. Remember I said there was support at 350 because there's 3 layers of confluence: the 50-day moving average, the Fibonacci, the 200-day moving average, and 50 week. I said 50 day. Yeah. Do you remember that? You see, there's no more ways to manipulate the market once we hit this 350 level. So look at how he covered. He covered in 30 minutes. Everything he shorted right here. Look at this. Look at this volume, dude. He fucking shorted right here. Look at this candle. Like, look at this one. Look at these 2 bars at this very bottom. Like, here's 1 bar. Here's 2 bars. These 2 green bars, right? This is where he's shorting, right? I wish I could like circle better. And then this is where he covered. He covered. And this is also the reason why this volume is bigger over here compared to over here is because he is not the only large capital trader. He's not the only hedge fund trading this. He's not the only capital investor trading this. So that's why this volume right here is like triple the volume over here, right? Because he's not the only one looking at this. Like, big money, smart money, knows how dumb retail traders think, which is why 90% of retail traders lose money. In order to be a successful retail trader, you have to know how the hedge funds are thinking. And this is how they are thinking. Right? Do you see how he covered perfectly at 350 where there was 3 layers of confluence? And you can tell he covered because of how big these candles are. There is no way these candles spike up this high unless everything he shorted right here was covered, and also because he knows 3 other hedge funds are looking at this price level. So this is why this spiked up, and everybody that bought 400 that got greedy and held till they were down 10%, 12% down here lost money. So what just happened right here, right? What just happened right here? What is game theory? Game theory for the stock market is a negative sum game. Not everyone can win in the stock market. That is the beautiful thing about the stock market, is that not everybody can win, right? If people tell you everybody can win in the stock market by investing in this company, you're dead fucking wrong, dude. Someone has to lose money in the stock market in order for you to make money, right? So what just happened right here? And all this red right here were all these retail traders who bought $400 and held because CNBC told them to hold because they're up 20%, right? And you know, retail traders are gonna listen to fucking TV. And they lost 12% of their portfolio down here because they ran their stops right here. The fucking hedge funds ran their stops. And this is where the beautiful thing of game theory comes in, dude. Stock market is a negative sum game because you have to pay fees, right? So it's not a zero sum game. It's a negative sum game because you have to pay market fees. It would be zero sum if there was no market fees. So in order for there to be a winner, which is the hedge fund, which they know how you think, someone has to lose money. So the retail traders lost money right here. And who just made money right here? The hedge funds right here. Because hedge funds know how dumb traders think. And they fucking cover right here. You see this huge spike within 30 minutes. This spike from what? Like, let's measure this. This went up 21% over from like 360 within that 30-minute time frame. This went up 21%, bro. We can measure this. This is like it's so obvious. It's so obvious once you change your psychology, right? Retail traders, what are they gonna do? They're gonna go to babyhips.com, and what are they gonna do? They're going to read all of this shit, right? They're gonna read all of this shit. How to trade Forex, all this shit. Complete this entire fucking course. And this is gonna be like 1 month of education. And then you go to stockcharts.com, and then you learn more to further your knowledge. And like, there's all this fucking market analysis. None of this shit is gonna help you, dude. None of this fucking shit is gonna help you, because even though this is all math and shit and it's technical analysis and everybody uses it, it doesn't teach you the experience. And the experience part here is knowing what the retail traders are thinking, right? You have to beat the retail traders. You have to. Wow, who's calling me? 1 second. Okay, so we're back. So I just explained this, right? So what was I? I was talking about how this was a negative sum game. Retail traders must lose money in order for big hedge funds to make money. And they know that because they know how retail traders think, right? So yeah, they fucking bought this support. And yeah, it's all mapped out for them now. It's all mapped out for them. So if you were the hedge fund, where would you sell? Where would you sell? Where would you sell? Like, it's so easy right here. You just use fucking Fibonacci's. You just use Fibonacci to plan your exits. you're gonna sell at either 618 fib or 786 fib, and this is how the majority of hedge funds operate. I'm gonna delete the old fibs because I already showed you that. And you're gonna plan your exit at this 786 Fibonacci at $836, right? And look at that, dude. If you bought at 350 and you sold $836 on the 786 fib, which is perfectly mapped out. Perfect, dude. Look at this. Look at this. You bought here, you know when to sell because it's a fib, and this is how majority of hedge funds operate. And it held this. This was the resistance. You sold this perfectly at this fib right here, and then look, it pulled back. Once it hit this fib, it pulled back, dude. Look at that. Look at how much it dropped. Once we hit this resistance, once we hit your target, the 786 fib, which was your target, right? So once you hit that target, look at how much it dropped. Like, just look at how like beautiful this pattern is. It dropped 21% as soon as it hits your sell target. The market dropped the Tesla dropped 21% as soon as it hit your sell target. Like, look at how beautiful this pattern is, right? And okay, you see it dropped 21%. And this is where you stay out of the market because you cannot predict what will happen next, right? You just gotta look at the price action, see what retail traders are thinking, look for a new market structure to form, right? So after you exited here, Fee, at the 786 Fibonacci, and you see this 21% drop once it hit your target, you just look for a new market pattern. You just look for a new market structure to form, right? And this is what you do for what the next 23 days, 24 days, 21 days. This is what you do for the next 21 days. And then, okay, 21 days later, you see we have broken this high. We have consolidated over here. And you know this whole entire area. Why am I talking like I'm Chinese? I think I'm talking like I'm Chinese because it's just so fucking obvious the way these market patterns play out. But you see during these 21 days, right, this is where resistance is. On this high right here. You see that? Actually, let's put this down to this low. And look at how many days we stay in this red zone. We stay there for 21 days. And what happens when everyone is expecting to sell 700 at 700? I need to fucking stop talking Chinese accent. What happens when everyone wants to fucking sell at $700 up to $850? Right? Everyone is looking to sell here. This is resistance. But what happens when you consolidate within a whole price area for too long? Right? If you stay in resistance for too long because there's so many people taking profits right here, what happens when you buy into all those sell walls, into all those sellers, right? You run out of sellers, right? This is for 21 days in this bearish order block, right? After 21 days, we finally break this high as resistance. So this is your signal to re-enter the market. Even though you took profits, it is okay to re-enter the market above what you sold at. Look, after 21 days, we finally broke above this high. So what is this signal? This is a bullish signal, right? It's literally so obvious the way hedge funds trade. It's literally so fucking obvious. This is why retail traders lose money. 90% of retail traders lose money is because these hedge fund managers know what these retail traders are thinking. But this would be your signal. You finally broke this high right here, right? But you would not buy immediately, right? Even though you broke this high, this could be a bear trap, right? This could be a bear trap. I'm not bear trap. This should be a bull trap. My bad. I'm just talking so much. It's fucking gotta fix my terminology. This could be a bull trap, right? You know what a bull trap is. Bull trap is where people see a breakout, say they buy directly into it, and then it drops below the entry, and they take a loss because it was a fake breakout. So what do you do when you fucking break above this high? You look for a retest of support, right? So you have broken this high right here. What are we gonna do? We're gonna look for the pullback, right? We broke this high. Here is the pullback, right? Look at this. We pulled back. We broke this high. We pulled back to retest this high that we broke to see if this will hold as support. And look at this, dude. This is beautiful. This is fucking beautiful. Look at this pattern, man. This repeats like in every single fucking market. But like, look at this, dude. This holds full perfectly. It retests this support. It literally retests this as support over the course. Look at how many times we touch this line. 1, 2, 3. Like we touched this line 3 times. And look, we opened the day after, right? This was actually a fucking, this was a bearish, this was a close under the support, but it's not a signal that the support failed, even though it only closed below 1 day. Like you have to close at least 3 days below the support in order to confirm that this support failed as a retest. But this retested it once, 2, 3 times. Even though this closed below the support, it opened above the support the day after. So we only closed once below this bearish line. There's actually more ways of confirming there's actually more ways of confirming breakouts and breakdowns. It's called Tom DeMark breakout qualifiers. Like you can read all into this. There's multiple ways and more advanced ways of determining if a support is broken or not. But I will paste this. Oh wow, I can't even fucking paste the entire link. But that's what's called Tom DeMark breakout qualifier, TD breakout qualifiers. So this is actually one of my favorites. But this is just very simple. A simple one would be to wait 3 days to see if this closes below 3 days in a row. But look, if you see that the next day opened above the support, even though the day before closed below it, but the next day opened above it, this is bullish, dude. You would fucking buy this on this day right here, right? If you're day trading and you see, if you see that if you see that this opened above support, even though it closed below it the day previous, you would buy on this day right here. Like, it doesn't matter when you buy, you would buy on this day. Because this is also a hammer. Is that a fucking hammer, friend? Hammer candlestick pattern. I don't fucking follow candlestick pattern. I follow price action. Yeah, this is a hammer candlestick pattern. I guess, I don't know. I wouldn't listen to candlestick pattern. They're all of it. Don't listen to candlestick patterns. Just fucking know how the price reacts. Like, you gotta know the flow of the market. But yeah, this is a hammer. Okay, I won't use any names, but look at this. The way these candles open and close is right here. Like, this is where it opens, this is where it closes, right? And you see that it opened higher than the previous close, which is very bullish, and it also opened higher than this support right here, this blue line. So this opened higher than the support that we may have broken the day before, but we actually didn't because we opened higher, which is very bullish. And also because we wick down, look at it. If something wicks down on that same day, but it closes above, if it closes above of a very small wick on top, if there's like almost no wick visible on the very top, that means we closed near the high of this day, right? If we formed a high of the day and we closed the market near the high of the day, this is very fucking bullish. That is why this candle is this is why this candle name, the hammer, is bullish. You don't have to know, you don't have to memorize the candle name. You just have to understand why it's bullish. It's because we close near the high of the day, right? We close near the high of the day and there's almost no high wick, right? If we're closing near the high of the day, that's very fucking bullish. If we wick really low, but manage to close near the high of the day, that means as soon as we try to sell, as soon as we try to get a sell off, people bought. That is why there's a big that's why there's a big wick right here. People bought because when someone tried to sell a really big order, other people bought. And since we close on the high, that's why this is bullish. So this is the day you would re-enter despite you selling over at like $850. It's okay to re-enter the market at a price higher than which you exited, of which you sold. That's why it's okay, because you want to be sure of your direction. And this is not 100% foolproof, but guarantee if you recognize these patterns, like, it will work at least 80% of the time. You heard the Mark too? Analytic? Yeah, the Mark is really good. Like, even though the TD sequential doesn't work as much anymore because too many people use it. Like, if too many people use the same strategy, it doesn't work anymore, right? But it kind of works, it kind of doesn't. Like, it's not as consistent. But TD sequential is just like a way of counting the candlestick patterns. Like I don't really use it, but it's a good reference because you should always further your knowledge to know how the retail traders are thinking. But TD sequential is more advanced. But a lot of traders still use it. It's better to combine it with like confluence though. You always want to find confluence in the market is the thing. When there's confluence, meaning more than one technical analysis strategies line up, then there is a higher chance that you will be correct about the next market move. But anyways, yeah, you would pretty much re-enter here. And then to plan for your exit for that move up, you would just use the same thing. Fibonacci. Fibonacci is the way to go, man. You would go for the 1.68 extension and sell over here, right? That's usually a safe exit point is 1.68 Fibonacci. You would use the retracement, right? You have the leg down right here. So you would use this retracement for your exit. And 1.68 is very safe right here. But instead, we actually fucking blew above that and hit all the way to 2.414, which is possible, but only in a very bullish scenario, right? So like you might have exited early, but you know, it's okay. It's okay to leave the market early because, you know, the thing about being a successful trader is not about greed. So even though you exited too early, it's not about catching the tops. It's about exiting your position green and making profits. So it's okay. You see this huge move up to the 2.414 fib, which is where it stopped perfectly, actually. What you would do is just look for a pullback, man. Even though you missed your maximum profits, it's okay to re-enter on a pullback. And look at where it pulled back, right? We said it broke the 1.618 Fibonacci. Where are we going to buy? We're going to buy where we sold at the 1.61 Fibonacci because the breakout above this expected resistance, which is $1,300.23, where we expected there to be resistance, you would draw this resistance line, right? Even though like there's no previous price action to draw this resistance line, you have Fibonacci, right? So you would draw a horizontal line right here and look for a retest of this price level, which is where you sold. Because even though you didn't expect this huge move to 2.414, 1.68 is a very good Fibonacci number. So you would re-enter where you sold if the market retests this price level, and it did. It retested this perfectly, bro. And then where would you sell again, right? Where would you sell? Remember how we planned our exits over here? We sell at 1.618 fib. And I wonder, I didn't even measure this move yet. So I wonder, where is this fib going to end? We would sell 1.618, right? Look at where this tops, dude. Fee, look. Are you still watching, Fee? Look at where this tops. 1.618 fib. Boom. Look at that. Look at that fucking boom, dude. Look at that red candle, dude. Look at where this stops perfectly, bro. 1.618 fib. Now, markets repeat patterns. You just got to be able to fucking find it. And in order to be a fucking successful trader, you have to beat all the retail traders. So what does that mean? You got to fucking have a higher IQ than all the other fucking retail traders. Because everyone is going to see the same shit on the market. But you have to know how they're going to think. And you have to know how they are going to act. And then you have to act to where your strategy is better than theirs. That is why you should never trade. You should never share your market secrets. Even though I'm sharing mine right now. But I don't fucking trade that much anymore. So I don't really fucking care. And even if this market strategy doesn't work anymore, I will find more market patterns because being a successful trader is being able to recognize a market structure, recognize patterns. It's not about learning patterns that already exist. It's about finding new patterns, right? That is why 90% of traders will fail because they cannot find new patterns in the market. They learn old patterns that no longer works, that 90% people are following, but they don't know the new pattern because they're just too fucking dumb, dude. They don't know how to fucking look for shit. They don't know how to discover. They don't know how to research the market patterns. You literally gotta have a really huge fucking IQ to like recognize these patterns or like be really experienced or just be able to know, dude. But yeah, look at where this fucking top right here, fee. 1.618 fib. And do you want to see something even more amazing? There is something called a bearish divergence. So a bearish divergence is where something called the relative strength index makes a lower high on the relative strength index, which is actually a measured move of RSI, which stands for relative strength index, is a measured move of how strong the momentum is. It's a momentum indicator. So what this says is that even though we formed a higher high on the price, right, 1700 on this high right here, or 1800 on this high right here, and 2100 on this high right here, even though we form a higher high, a dumb trader would buy because they think, oh, this is bullish, right? This is bullish because we form a higher high. This is going to keep on going up because now this guy's actually the R word, which I can't say on Twitch. But someone who's a little bit more technical, more advanced in technical analysis, this isn't even fucking technical. This isn't even fucking advanced TA. This is still fucking basic. Like this is like, I guess this advanced, it's still advanced TA, but it is not like experienced TA. A lot of people use this bearish divergence right here. So this means that even though we form a higher high, the momentum is getting weaker. This is why I think Tesla will top right here. And you also said that Tesla will top right here. And this is $2,000, which is also a whole number, which a lot of traders like to use for resistance and support. Whole numbers are really good numbers for resistance and support. Even though hedge funds know how to manipulate it, you just have to be able to average down into it in case they do decide to manipulate it. Because you never know when market manipulation is going to happen. So that's why you never want to go 100%. That's why you never want to leverage. Because there is a chance that we still break this high right here because a hedge fund decides to manipulate Tesla. Even though, because what's going to happen right now, Fee? Hedge fund is going to see there's a bearish divergence, right? And we form higher high. Retail traders are going to think that, oh, this is going to drop, right? So hedge fund will know that retail traders are shorting this. This is probably why you see a big red candle today, Fee. It's probably because retail traders are shorting it, but hedge fund miners might not be shorting it yet. This is a 5-for-1 stock split on August 21st. Wait, August 21st? Is that next year? It's already August. You mean September? Wait, when is Tesla stock split? Oh no, did my mouse just die? Okay. On 31st. Okay, yeah. So that's really good fundamentals too. This is something that market technical analysis will. This is also why I should pay attention to fundamentals as well, especially when it comes to stocks, because there's a stock split on August 31st. So look, retail traders are shorting right here, right? But you are Fee. You are smart. You trade on a different market spectrum. You trade on fundamentals. Noob traders, 90% of the traders are shorting right here. That's why there's a big red candle. These are dumb retail traders. So you know fundamentals. So this will likely continue all the way up until August 31st. And these retail shorters that made this red candle today, these retail traders that made this red candle today are gonna get stopped out. Just like how I explained way down here. Just like how I explained what happened down here. Remember when I said like $400 is where hedge funds are gonna stop out these traders? Same thing is gonna happen right here, I bet you. Because you use fundamentals, so you gotta account for that as well. Even though retail traders see this as bearish because there's a bearish divergence on the technical analysis, fundamentals say that it can still go higher because there's a stock split on August 31st. So this will likely continue to August 31st, and it will likely run these stops on these highs. And then after it runs those highs, people who shorted over here will have to force cover. So the price is probably going to skyrocket even higher. So this might even go to that 2.414 fib. Like what happened right here. This might even go to that 2.414 fib and end at 2400. This might even stop at 2400 because of that stock split and because of the short squeeze over here. So this might rocket to 2400 before it finally tops off. Like even though there's a bearish divergence right here, it could still keep on going up. Because what could happen right here, and this is very common, is that you can form a triple peak bearish divergence, and this will go up with 3 peaks, and then you get these 3 lower peaks over here, and you form these three lower high peaks over here on the relative strength index on the oscillator, and you will form higher highs. And usually you never see anything anything more than a triple peak bearish divergence ever. If you see a quadruple peak bearish divergence, that's like getting hit by lightning. The same fucking pattern happened in the stock market, which I will show you. I mean, I think I'm done talking about Tesla. But yeah, this will probably talk about 2400, and then you'll see something like an ABC correction, which is like some Elliott wave shit that doesn't always fit to profile. But I'm guessing if that does happen, you'll see something like this, this dropping from 2400 to like 1300 within the course of over a year is what will likely happen, since there's a stock split on the 31st. So yeah, I don't want to go over the Elliott wave shit because that's very subjective, and it doesn't always work out. It's just that it follows a specific pattern, but it doesn't produce what the price will be. But it will likely fall around 1300. But what I was talking about, the triple divergence, look at the fucking stock market, bro. Actually, this is futures. I don't want futures. I want the SPX. SPX is more history. But look at the stock market, bro. Look at triple peak bearish divergence. Where is it? 1 peak, 2 peak. What was on the weekly? Is it 3 days? Oh, it's actually over here. Look at this. Like 1 peak, 2 peak, and then I guess this is like the 3rd peak. But this peak made it higher. So this actually invalidated it. So this is actually just one bearish divergence that made this fall. It's not a triple peak, actually. I think it occurred on the 3-day, maybe? No. Let's look at monthly. Ah, monthly. Look at this, monthly. Okay. This is the triple peak right here. Look at this big crash. Remember this crash from 3200 to 2200? Look what happened. Fee. There's a triple peak bearish divergence. Remember? Nothing ever goes more than a triple peak bearish divergence. 1 peak, 2 peak, 3 peak. 3 lower highs, 3 higher highs. Look at this huge collapse of this like 1100 point drop within this entire month. So this is one pattern to look out for. This is like almost always 100% certain if you go 3 peaks. Anyways, I will be back. I'm done talking about stocks. I'll go back into Kovacs. I don't know why I explained about stocks for so long, but be right back. But yeah, I'm just curious how you would analyze this, V, because I know you trade on a different market spectrum. So I'm just curious. But I'll be right back.